Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, August 12th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. The chart that we will be working off of today is a weekly candlestick chart of the S&P 500 that goes back to the beginning of 2021, gives us some nice time perspective. So each candlestick on this chart does represent 1 week of trading. The blue line I have set at 4,300, and we'll talk about that and the importance of that. So I've started off with a few annotations here just to get us started, but we're going to take a look at this chart and do some annotations and see what we can learn together. To start off with, the S&P 500 was up 3.26% this past week, so a very nice week on the S&P 500, and we closed at 4280.15. Now, the reason I started off with this 4,300 line is I was curious as to, and I wanted you guys to also see when the first time we ever traded up to 4,300 was, right? And what has happened since. Well, the first time we ever traded up to and above 4,300 was back in June of 2021. And you can see the trading that we've had above that, but we have not had any weekly closes on the S&P 500 above 4,300 since clear back here in April. Okay, so all of the trading, right? I mean, you can see where we kind of poked our head up, just a little bit as on the wicks of these candles. If you're looking at this, hopefully on a larger screen, you can see when my cursor is circling. So we've had a little bit of trading up to and around that 4,300 level at the tail end of April, beginning of May. But since then, no trading up to 4,300, and where we're at right now, 4280.15 is as close as we have gotten. Now, stay with me, guys, because this is I just needed to get this set up here, but this is where we're going to start doing the deep dive. Now, we've had 4 weeks in a row where the S&P 500 has been positive. So I'm going to pull up my annotation tool and let's start circling some things and doing some annotations and see what we can learn here together. So there's 4 weeks in a row where the S&P 500 is positive. Now, that is the first time, right? If we look back here and they go over all the candles going clear back to the beginning of 2022, we can see that is the first time this entire calendar year where we've had 4 weeks in a row where the S&P 500 has been positive. And the last time we even had 3 weeks in a row where the S&P 500 was positive was right here in March. And then you can see we rolled over and went lower, all right? So to get at least 4, so the question in my mind here is, well, all right, how often does this happen? Well, here in October of 2021, we had 5 weeks where the S&P 500 was positive, and then we go backwards here, and we can see 2 weeks, 1 week, 3 weeks, 3 weeks, and then here we have another session right here in 2021 where we had 4 positive weeks in a row. But that's it. So basically, we had 1 4-week and 1 5-week stretch in 2021, and this is the first one in 2022. All right, let me just save these annotations here. So I think, I think the first thing, right, the first takeaway here is what we just experienced is pretty rare, right? Going back a year and a half, this is the third time that we've had, going clear back to the beginning of 2021, where we've had at least 4 weeks in a row where the S&P 500 has been positive, and there was only one time in calendar year 2021, which, as you guys know, was a really good year in the markets, where we had 5 weeks in a row where the S&P 500 was positive. So anything more than 3 weeks in a row is pretty rare, right? It happens, as we can see here, based on this research anyway, maybe a couple times a year. And it's the first time it's happened this year. Now, then the question in my mind becomes, all right, what happens after that? Well, we can see here after this 4-week stretch in 2021, we went sideways for basically a couple of months before the market moved higher again. And then after this 5-week stretch, then we got into that sloppy, choppy trading, and then the market fell. All right, so I think a realistic expectation right? At going forward, at least for the next week or so, it's possible we could get another positive week in the S&P 500. But there's a lot of things out there, right? As we know, that are going against us. And we're coming up to some areas where we, have really had. We don't have a lot of trading in the S&P 500 ever above 4,300, right? Less than a year of trading, as we can see right here. Okay, that's it. So we're getting up to some serious overhead supply and overhead resistance points. We've now had 4 weeks in a row where the S&P 500 has been positive. Generally, after that, you get at least a stalling action, if not a pullback. The Fed is still raising rates. We're now in the worst 3 months of the year for the stock market. I mean, I'm not trying to be negative here. I'm analyzing the data, all right? So, could we have another positive week and push above 4,300 next week? Absolutely. It could definitely happen, all right? But I think we're at a point here where any bad news on the market may start to affect us. The other thing that I think is possible here, and this is if this is the case, guys, and I was looking at this chart before I, as a matter of fact, I'm just going to annotate it. Before I obviously started the video, and what I saw here was the potential. We've got a potential, which has already happened. This will make sense in a second, so bear with me. Possible head and shoulders pattern here, all right? So if this is the case, all right, let me get rid of this. Put the head there, and I'll get all this stuff lined up and explain this here in just a second, but I wanted you guys to see how the analysis is done. And so this would be the right shoulder. Now, this is one way to look at this, right? And, each technician can do their own work and design things however they want. But, when I look at this chart, another thing I'm seeing here is what could arguably be a head and shoulders reversal pattern where here's the left shoulder, here's the head, and here's the right shoulder. And basically where we're at right now, this 4,250 to 4,300 level is the neckline, all right? So we're coming up to where we've bounced back to this neckline of this head and shoulders pattern, and this would be, again, another reason, right? Another really high resistance point where it could be pretty tough for the S&P 500 to advance up past 4,300 or much higher, right? We might obviously push 4,350 or whatever, but the further you get above this area, the more resistance we're probably going to run up against, all right? The other thing that I want you guys to see here is, and again, it's going to start getting busy, but hopefully you guys are enjoying this and seeing, this is how I do the analysis, right? You start just, playing around with things. You start to look. And what I'm going to do here is throw the Fibonacci tool in here, but I want to start with this particular pullback that we had at the beginning of the year, and I'm just going to move this head up and out of the way just a little bit so you guys can see this a little easier. You know what? And then, bear with me here, guys. And then I'm going to shorten up this. I think I've got some stuff updating on my computer as well. So Microsoft stuff, so it's kind of slowing things down a little bit. Apologize for that. And then I'm going to shorten up this time frame here and go back to just, actually, I'm just going to go back to like September of last year. All right. Again, I want you guys to be able to see me do this live. All right, so this will be a little easier for you guys to see. Now, what I want you to understand is, and what I've done here is I've dropped this Fibonacci retracement tool at the start of this downturn back here in January, right? January 4th of this year was the peak in the market. And then I went to where the lows were right here in February before we had this retracement. What I want you to understand, see that 61.8% retracement? We had the drop, and then we had we retraced basically over 2/3, about 70%, right, of the drop, and then the market went lower. That is not unusual, all right? So what I'm telling you here, the point I'm trying to make is that it is not out of the question at all First thing I want to do is go back to January of 2021. It is not out of the question at all for this market to roll back over and go lower, all right? And so if we go back here and go to the lows, we know that June 17th, 36.36 and change was the low of the downturn so far. Again, I've got the Fibonacci tool lined up on the top here. I know the chart's busy, but it's important for you guys to see all this together and kind of see the aggregation of data. All right. And so if we look at this entire retracement, right, here's our entire drop from the peak in the market in January to the lows in June. And then we look over here, we can see that where we're at right now, and I know it's small and maybe hard to see, and perhaps I'll zoom in here again. Let me just go to like a 6-month chart real quick. Kind of save us a little time. I'll just do it that way. Actually, I'm going to need a little longer period of time. Let's go to 9 months. Okay, just so you guys can see all of this. All right, but if we look here, we can see that where we're at right now, right, where we closed at 42.8015 on Friday the 12th, is over a 50% retracement, right? Here's that 50%. I know it's hard to see, tiny, but there's the 50% retracement of the entire move, laying just above 42.25, about 42.26 and change, all right? So the point is, you've already seen that here we had this retracement, and we retraced 2/3, had 3 positive weeks in a row, and then the market rolled over. My point is that it is completely possible, right, and perhaps even probable to some degree that we're going to, now that we've retraced more than 50%, but less than 61.8%, you may know that 61.8, 50, and 38.2 are kind of some of the main Fibonacci numbers, all right, which is why they're already put into the Fibonacci tool here. Tons of Fibonacci numbers out there, but these are the main ones to worry about for technical analysis. But now that we've retraced a little bit more than 50% of the downturn, right, we've retraced 50%, it would not be uncommon at all for the market to stall, roll over, and go even lower. That is a complete possibility. Guys, I don't make predictions because I can't predict the future. But guess what? Nobody else can either, all right? So, at this point, we're at a very sensitive spot here. This is a tricky market. It is... so we've got basically one of 3 things I think are going to happen, all right? And we're either going to, after 4 weeks positive, we're going to stall out, go sideways to slightly down, maybe consolidate the gains. That's probably one of the best scenarios where we consolidate the gains, and, then that might allow us to move higher towards the end of the year. Consolidate August, September perhaps, and then, make a run into the end of the year and see the market up, higher than we're at right now towards the end of the year. But it's also, I think, completely plausible that the market rolls over here, and that would not be out of the question in a very, in a longer downturn. And when I say longer, I'm talking about 2003, 07, 09. You get these rallies where you can, retrace, a third, a half, 2/3 or more of the downturn, and then something else happens and sends the market lower. So we are vulnerable to that type of an action at this time, all right? But it is also completely possible that there's enough money coming at this market, institutional money, retirement plan money, so many people indexing these days, putting money into the S&P 500 and or other, things that might continue to drive the S&P 500 holdings higher. And then, bond yields are low. I mean, there's just a lot of reasons why people are going to continue to want to be in equities versus other investment alternatives. And so we might, be looking on a go-forward basis at a higher multiple on the stock market. In other words, even if earnings do come down, flatline to come down, over the next 6 to 12 months or whatever on the S&P 500, it's possible that, people will look at all the other investment alternatives and say, you know what, equities are still the best, the best bet out there, and they'll continue to drive money into equities and prop up the market with, with higher multiples. So that is another completely possible situation here, guys. And so, I'm just walking you through the thought process here. Again, people can have opinions, they can have, predictions or whatever, but, it, it just doesn't matter. My point is, what you and I think about the stock market doesn't matter. The only thing that matters is the stock market itself. Okay, so hopefully that made sense. There is nothing easy about this, as I hope you guys realize, and I'm trying to give you the best possible data. I'm showing you how I'm doing the analysis. I'm sharing with you the thought process. There is no, there's no way to know for sure what is going to happen. The best we can do is look at an if this then that scenario and go from there. Now, the other advantage I have and my subscribers have is my proprietary model, Simple Market Signals, which took me over 20 years to develop. I developed it for myself. I share it with you guys for a very small fee every month, and publish the information every week. So if you want to learn more about how you can get a huge advantage and end up with more clarity on where the market is at based on my proprietary work, that again took me over 20 years to figure out. And, guys, it works, right? I'm not just some guy with a YouTube channel. I'm a former financial advisor, a former VP of a major mutual fund company. I've, made thousands and thousands and thousands of individual trades. I've worked with over 6,000 financial advisors in my career. I've read hundreds of books on the stock market. I had 4 securities licenses, 5 industry designations, my life accident and health license, at the peak of my career. Sold my practice in 2016, and then, completed the work on my model in 2017. So if you want to learn more about all of that and how you can benefit from it for way less than $1 a day, stay tuned to the rest of this video. Do you manage any of your own money, including in your 401k or IRA? Are time and money important to you? If time and money are important to you, then Simple Market Signals should be important to you as well. Simple Market Signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need Simple Market Signals. Simple Market Signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple Market Signals is equity investing information simplified. Simple Market Signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime, and a subscription to this information is less than 67 cents per day, and it's priced way less than it should be for the value it brings. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. So again, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com.